Let's look at capital gains tax in details. Capital gains tax was introduced in Uganda effective April 1st, 1998, and it applies to all capital assets sold or transferred from that date onwards. Though we have exemptions like the gains from the disposal of depreciable assets, they are not subject to capital gains tax under the Income Tax Act. We have exemptions. The first one is the gains from the disposal of depreciable assets. They are not subject to capital gains tax under the Income Tax Act. So gains from selling assets that lose value over time, e.g. machinery and vehicles, are not taxed under CGT. The second one we have is the gains on assets eligible for capital deductions due to loss in value. They are also excluded from CGT. For example, a factory building that qualifies for tax deductions on wear and tear is excluded from CGT when sold. So let's look at the consideration received on disposal. Consideration is the money or the payment that is received on the disposal of the assets. So normally this is the selling price or the market price in an arm's length transaction. And for non-cash transactions, it is the market value of the asset received in kind. If you do barter exchange, you give someone an asset and they give you another asset in return. So the consideration is the value of the asset you've received in return of the asset you've given. So consideration received is always the selling price or the market value of the asset received. So an arm's length transaction, it means a transaction between two independent parties whereby each is acting on their own and in their own best interest. That is an arm's length transaction. Then a non-arm's length transaction is a transaction between two related parties or parties that are close to each other or that have a close relationship, which can influence the pricing. In an arm's length transaction, we said here the parties are independent. You meet a buyer from you don't know where, and they also don't know you, so you're two independent people and everyone is acting in their own best interest. That is an arm's length. So in an arm's length transaction, the cost base is the purchase price and incidental expenses. For example, the legal fees, the valuation, auctioneer's fees, etc. So the cost base includes the purchase price and incidental expenses. That is in an arm's length transaction. Then in a non-arm's length transaction here, the parties are close to each other. They have a close relationship or they know each other. It's like selling something to your friend. It's not the same way as selling it to a stranger. So when you're selling it to a stranger, it is an arm's length transaction since you're independent parties. But when you're selling it to someone, you know it is a non-arm's length transaction because your relationship can affect the pricing of the asset. So in a non-arm's length transaction, the seller is considered to have received the higher of the two, the original cost base of the asset or the fair market value at disposal. So the higher of the two is what we consider as the consideration received when selling an asset in a non-arm's length transaction. So if the original cost of the asset is higher than the fair market value, then we take the original cost. If the fair market value is high, we take it and we ignore the original cost base. The fair market value is the price an item would sell in an open market whereby the buyer and the seller are independent from each other. So the cost base in a non-arm's length transaction, we consider the higher of the two, either the original cost or the fair value.